Hello everyone, I'm Dr. Kalpana. Today we are going to learn about amalgamation and merger of banks in India. Amalgamation and merger in banking sectors are strategic tools which strengthen financial system, enhance competitiveness, and ensure financial stability and promoting inclusive growth. That is the objective behind keeping that legal provision of merger and amalgamation of companies. And here we are going to discuss about bank mergers because that's the topic which is related to banking law. So in India, bank amalgamation is governed by statutory provisions and regulatory guidelines and judicial pronouncements. So bank mergers, whether voluntarily or mandated or interchangeably, can be called as forced mergers, have profound legal implications and mechanism and framework we would be discussing today. And we would be exploring what is the legal framework to govern mergers and amalgamation of banks in India and its objective, rationale, and process, and significant cases. Recently, we saw a lot of public banks were merged by Government of India at the instance of RBI. Before going to the legal framework, we would be knowing the meaning of merger. What is the meaning of merger? Because it's a legal term. So merger is a process where two or more companies combine with one company absorbing other. And bank is also a company which is having certain mm, features. So that's why we call it a banking company. Otherwise, it comes under a corporate personality definition. So, absorbed company cease to exist and all their assets, liabilities, operations are transferred to surviving company. And the shareholders of absorbed companies receive shares in surviving entities. For example, the key elements are like this. One company remains operational while others dissolve in that surviving company. Surviving company retains its identity and continues its business operations. Shareholders of merged companies receive shares in surviving entity, and the primary aim is often to create synergies, reduce competition, or to expand market share. These are the primary objective why we go for mergers of companies or banks. Now, question is, what is the meaning of amalgamation? An amalgamation involves a blending of two or more companies to form a completely new entity. All participating companies dissolve their assets, liabilities, operations are transferred to a newly formed company. Shareholders of original company receive shares in the new entity. For example, when State Bank of India came into existence, there was a amalgamation of three presidency banks and State Bank of India came into being, and that was the first amalgamation which took place in 1955. And the key elements of amalgamations are a new legal entity is formed. All amalgamating companies cease to exist. They are no more in existence. Shareholder receive shares in newly created company and use for strategic restructuring, financial stability, and expansion of into a new market. That is the purpose of amalgamation. Uh, Here, I would like to tell you what are the key differences so that you can understand both amalgamation and merger are two different concepts when it comes to understanding as a law student. Uh, there are certain aspects where they differ in their process and outcome. A legal identity, one company survives when it comes to merger and other merge into it. For example, recently, Syndicate Bank merged with Canara Bank, OBC, and United Bank of India merged with the PNB. So PNB is surviving, other are not surviving as banks, and that is called merger. All companies dissolved and a new entity is formed in amalgamation. Formation absorbing company continues. A completely new company is created under amalgamation. Shareholding pattern. Shareholders of merged company become the part of surviving company in merger, whereas shareholder receive share in a newly formed company under amalgamation. Purpose. Under merger, the purpose is to achieve synergies, reduce competition. Under amalgamation, business restructuring and diversification is primary and ultimate purpose of why amalgamation takes place. Impact on brand, surviving company retain its name and brand, whereas under amalgamation, new brand is often established. So these are the differences so that you can understand what is merger and how it is different from amalgamation. Now coming, that is the most important aspect of today's lecture. That is a legal framework which governs mergers in India when it comes to bank mergers or amalgamation is concerned. So primary legislation to govern merger and amalgamation of banking companies is governed by Banking Regulation Act 1949, and Section 44A provides the primary legal framework under Banking Regulation Act. So that is an important section to keep in mind. The scheme of amalgamation must be approved by two-third majority in value of shareholders. That is the first requirement where amalgamation or merger takes place. And sanctioned by the Reserve Bank of India. So Reserve Bank of India plays vital role when it comes to approving that initiative of amalgamation. Once sanctioned, scheme is binding on all stakeholder, shareholders, or whoever is the stakeholder in that banking company. Second legal provision we do have in Companies Act 2013. Section 230 to 34 are relevant for private and foreign banks. However, banking companies are largely governed by Banking Regulation Act in the event of conflict. So, Companies Act 2013 applies on foreign banks and private banks, not on public banks. So, role of Reserve Bank of India: sanctioning a scheme of amalgamation, protecting depositors' interest and ensuring systematic stability. So RBI being the apex bank of India and single regulator bank for all commercial banks. So RBI role is most significant role when it comes to merger of or amalgamation of bank is concerned. Role of Government of India is also important when it comes to public bank mergers. So Section 35, subclause 2 of Banking Regulation Act and Article 246, central government holds power in public sector bank mergers. So under Article 246, central government has been empowered to take initiative when it comes to merger of public banks. Recently in 2019 and 20, lot of public banks were, we witnessed the merger we would be discussing next. Now coming to we have what kind of mergers, types of mergers in banking sectors are of two kinds. Voluntary mergers initiated by board of merging banks. This usually happens between healthy banks for synergy and expansion. These mergers are driven by the desire to enhance market presence, improve operational efficiency, and offer a broader range of services to the customers. Forced mergers are important to understand because when a bank is not working well, directed by RBI or the government, often in the interest of public and financial stability, when a financial health of a banking company is not good, then such kind of mergers can take place in the interest of the depositors. So typically used for weak or insolvent banks. So primary goal is to protect depositor and maintain the integrity of the banking system. So at the instance of RBI or central government, such kind of mergers can be seen. There are certain cases which are having historical cases to remember, keeping in mind when it comes to noting certain historical mergers in our country. So several landmark cases and mergers have shaped the banking landscape in India. State Bank of India versus National Industrial Corporation, 1971. Supreme Court observed that RBI sanctions a scheme. Judiciary should show restraint unless there is a violation of statutory provision, meaning thereby Supreme Court approves that RBI is having all powers when it comes to governing mergers and amalgamation of bank, unless if there is a violation of any statutory provision like Banking Regulation Act. Merger of Global Trust Bank with Oriental Bank of Commerce, OBC, 2004, RBI stepped in and merged Global Trust Bank with Oriental Bank of Commerce to protect depositors and banking system. That is a very important case where you can understand what are the objectives when there is a forced merger. There is an example of forced merger. It's not a voluntary merger. Merger of ING Vyasa Bank with Kotak Mahindra Bank 2015, a voluntary merger approved by Reserve Bank of India Section 44A and aimed at leveraging synergies and expanding market share. So we do not have any ING Vyasa Bank as of now. It is merged with Kotak Mahindra Bank, and it is an example of voluntary merger, whereas Global Trust Bank with OBC is a forced merger. Merger of five associate banks with the State Bank of India in 2017, approved by Cabinet and RBI, making SBI among the top 50 global banks. Merger of public sector bank took place in 2019 and 2020. A government-led mega consolidation aimed at creating a large bank capable of meeting global standards. So merger of State Bank of India, State Bank of Bikaner, State Bank of India, State Bank of Mysore, State Bank of India has become the world's second largest commercial bank by assets and number of its branches. Merger of Canara Bank and Syndicate Bank into Canara Bank. Canara Bank have become the fourth biggest public sector bank in terms of business volume. Merger of Bank of Baroda, Dena Bank and Vijaya Bank into Bank of Baroda, fifth largest public sector bank. Oriental Bank of Commerce and United Bank of India merged with Punjab National Bank. Andhra Bank and Corporation Bank merged with Union Bank of India. Syndicate Bank merged with Canara Bank. Allahabad Bank merged with Indian Bank. So these bank mergers were uh, since these all are nationalized public banks, and it was a government initiative in consultation with Reserve Bank of India to merge these banks in order to make them larger and capable of meeting global standards. So merged major banks with bigger banks. So State Bank of India becomes the second largest bank, and so that is a kind of an achievement when it comes to banking landscape of India is concerned. So that is a very recent, and so with this, I would end here. So happy learning. Take care.